After 26 years at JP Morgan and a stint in asset management and as a UK policy advisor, Bill Winters became CEO of Standard Chartered in June 2015. His mandate was to jerk the alien emerging market specialist back into life, and so he did. He quickly shored up capital and improved the quality of the loan book, and after last year's loss, 2016 interim results have been encouraging, although somewhat short of analyst expectations. The bank's main ongoing challenges: low economic growth, regulation, and political uncertainty. I spoke to Mr. Winters this November at the Financial Times Banking Summit in London. We started our chat discussing the future shape of international trade deals and the rise of populism in the West.
Well, I think we'll all be analyzing for many years to come how the different variations on the populism or inequality or people left behind theme is going to change the business environment in which we all operate. And clearly there are some underlying connections between Brexit and the US election outcome. And obviously we're all looking forward to European elections and other things that could play off a similar theme, Italian referenda, et cetera. So tons of open questions. I don't think we should lose sight of or lose our focus on what the underlying issue is, because the impact of these changes obviously is dramatic and uncertain, very, very, very uncertain. So I know you've talked about that, and my view is no more informed or insightful than anybody else's, I assume, simply because who could know? I think the proponents of these policy changes themselves probably don't know what they have in mind, and that's pretty clear. But the underlying causes of populism is to some degree a pushback on globalization and a pushback on the way that the value of globalization is shared. There's a fabulous chart that I'm sure you've all seen that shows the division of profits between labor and capital going back 100 years, as best one can analyze this. And to grossly simplify it, basically, labor got 60% of the share of global profits, and capital got 40% of the share of global profits up until the day that China entered the WTO, at which point the lines began to converge and are now 60-40 the other way. So if we want a moment in history, and it's not obviously all China, and it's not obviously all the WTO accession, but there's something there. And so now what's going to change? Is 60-40 the other way just the new norm? Capital gets wealthier and labor gets relatively poorer? Unlikely to survive in a democratic world. You either ditch democracy, which I wouldn't advocate, or make some accommodations. And that'll be the big debate of our times. What's it mean for a bank like Standard Chartered? Potentially quite a lot. We're a trade bank. Our business is cross-border, dealing with emerging markets. So we're in the line of fire if you think that there's going to be a China-targeted trade war. That would be offset by the response to a US-initiated China-targeted trade war, which would be inevitably regional trade blocs that absorb much of the trade into and out of the US that was happening otherwise. So, and of course that's happening in any case. I mean, China is internalizing its supply chain, it's internalizing its distribution chain by focusing on a more consumer-led economy. And they're building extensive relationships with the rest of ASEAN, getting into South Asia, obviously with Africa, to internalize their trade flows so that they're not reliant on the US. So I would say totally independent of the outcome of the policy decisions that the new administration in the US will go through, the rest of the world is going to organize themselves with a less important US in mind. You're not going to rely on the US for security. How could you possibly? It would be imprudent to rely on the US to the same degree that you did yesterday for your security.
What's the alternative?
China.
What would be for
China.
Security? Okay.
Well, you cozy up to the other guy. I mean, how could it not happen? It already has. I mean, it happened before the election with the Philippines. So I think that's inevitable. And you're going to focus less on distribution into the US market, and you're going to focus less on taking exports from the US market, and you're going to focus less on acquiring US technology. You're going to focus on developing it yourself. All these things began before the election. They'll be catalyzed for further development post the new administration. And there are great opportunities in there for an emerging markets bank.
As banking regulation evolves, Mr. Winters is concerned about the uncertainty over the nature of stress tests in Europe. Will they continue to provide guidelines or become binding constraints as is in the US?
Trying to manage banks is whether the intention is for the stress test to become the binding constraint on capital requirements or intended to be a guideline. So we can all see that CCAR in the US is the binding constraint on big US banks in terms of their capital requirements. I have to go on the assumption that the stress tests will become the binding constraint for Standard Chartered and other banks, first in the UK, and then I think later in Europe, because the regime is migrating more delicately, I would say. Now that could change if Basel IV comes out to be highly restrictive itself. So if the continuous protestations that there's going to be no material increase in capital turn out not to be true, and there is a material increase in capital, then that most likely will be the binding constraint, and stress testing will not. But it's an open question. I think for all of us running banks, it's hard to plan your business around a world where the stress test is the binding constraint when the stress test scenarios change in unpredictable ways. Of course, we've had this discussion with the regulators, and their response is, that's why we don't want it to be the binding constraint. Okay, what you want and what you may be able to do, or what you may inadvertently do, remains to be seen. In the US, it's very clear. CCAR is the binding constraint, and for some period of time will likely remain the binding constraint. So I think, as with so many things, we're in a very uncertain place right now.
Lastly, Mr. Winters discussed the impact that regulation, Brexit, and the US new political leadership may have on Standard Chartered and banking in general.
Very bad, surprising, stress outcome could hurt us, but for the most part, the things that we've been doing at Standard Chartered for the past year, and what we'll continue to do for the next year, are entirely within our control. As I say, we just have things that we need to do. We've done a lot. There's a lot more that we have to do to make things better. And those things will be more important to us than the political noise on the outside, whether it's Brexit or US election, or unless it's something very dramatic, some big geopolitical event, which obviously none of us foresee immediately. In the longer run, those other things will matter more, I think. Once our own ability to change dramatically is reduced, and the effect of some of these external shocks are really felt in terms of capital requirements, geopolitical trends, Brexit, the reality of Brexit.
Okay, and I think I still have time for one more question, and then we'll ask the other panelists to join us. So post-Brexit, Standard Chartered's shares got a little bit of a boost because you guys are obviously emerging market specialists. I know you're not necessarily too concerned about share prices. Is that still your point of view even after the current uncertainty?
Yeah, no, I'm not concerned at all about the share price in the short term. I think a big part of the boost that we got post-Brexit was the fact that we're a dollar-based company quoted in sterling. So we just got the currency effect on our stock, and I'd love to take credit for that. But it's nothing to do with me or any of us, frankly. But we're quite a bit off the bottom in terms of our share price because we've taken a lot of the market concerns off the table. I think likewise the U.S. election, it's been great for a bunch of investment banks, and it's been less good for an emerging market bank. Again, for the obvious reasons that we're seen as a proxy for globalization to some extent, which is true. I'm not particularly pessimistic about I don't have any reason to think that globalization is going to go into reverse. There is a question whether we will globalize as quickly as we might otherwise, or as we have been. But as I say, we're trading at 60-65% of book value, which obviously is depressing to think about. The things that we can do to get to demonstrate that we can generate a return on capital that gets us at least back to our book value and above are entirely within our control, absent some terrible shock from the outside. So that's what we're focused on. And it's a long game. We'll play it out. And if the market wants to throw our shares around up and down along the way, be my guest. But that's not what we're focused on.
All right. Well, thank you so much, Bill.